Dear students, welcome you all to the third module of Personal Investment Management. The third module is how to invest in stock market. So far we have finished 16 sessions comprising of two modules. The 17th session will begin from the third module, and the topic of this session is meaning of stock market securities. So let's understand what is the meaning of stock market securities. So stock market securities are financial instruments that represent ownership or debt and are traded in public or private markets. So very clear meaning. So stock market securities are also known as financial instruments. So what is this financial instruments? So these instruments have a financial value and they represent either ownership or debt. So they are also called as ownership instruments or debt instruments. So ownership instruments means after purchasing that instrument, you become the owner of the company. Debt instruments means you become a lender of the company. You give loan to the company. So both these instruments are traded in the public or private markets. So we have two types of markets in India. One is government stock markets and private stock markets. So all these financial instruments are traded either in the government or public stock markets or private markets. So they are the backbone of the stock market and come in several forms. So without financial instruments or stock market securities, definitely there is no existence of stock market. So stock market just operates only because of the stock market securities or financial instruments. And there are various forms of stock market securities. Let us discuss one by one. So basically there are three types of stock market securities: equity securities, debt securities, and hybrid securities. Let's understand the meaning of equity securities. So equity securities are financial instruments that represent an ownership stake in a company. So only one instrument, stock market instrument, which give you the ownership right or ownership stake in a company, and that particular security is known as equity security. So what happens when you own a equity? You are not just investing in equity securities, rather than you are becoming the part owner of that business. So that is the fundamental feature of equity securities. And apart from that, you also receive dividends and voting rights. So what is dividend? Dividend means the part of profit at the end of the financial year. You definitely receive the part of the profit from the company since you are a owner of the company. And also you get the voting rights. You can vote at the important corporate decisions of the company. So let's understand the features of equity securities. So what are the various characteristics? First one is ownership rights. Own a portion of the company and share in its profits and losses. So definitely, as a fundamental feature of equity securities, you own a portion of the company's assets, and also you will get either profit or loss. It depends on the business. If the company earns profits, you will get profit, or if the company is not able to earn the profit, then definitely you have to share the losses. Then voting power. So you get the voting rights in corporate decisions, especially the important decisions like electing the board of directors, electing the independent director, then maybe important decisions like mergers, acquisitions, or change of product, change of place of business, etc. Then dividends. So dividend means part of the profits. So distribute a portion of profits to shareholders as dividend. So then since you are a owner of the company, definitely you have the right to receive the profits of the company. So profits of the company are divided to various owners, shareholders. They are known as shareholders at the end of the financial year. So you have a right to receive the dividend from the company. Then capital gains. So what is capital gain? So it is selling your shares at a higher price. So you might have bought the shares at certain price, and definitely after some days or some years you are going to sell those shares at a higher price. So difference between the purchasing price and the selling price, your gain, and such gains are known as capital gains. Risk exposure. So risk exposure, definitely at the liquidation of the company, you are the last person to receive your share from the company. And there, apart from that, there is a lot of market volatility. As you know, market will not move in the same direction. There are a lot of variations in the movement of the prices of the shares. So definitely you have to accept such exposures or volatility in the market. Then there are various types of equity securities. Let's discuss all these types of equity securities and also their features. So first one is common stock. So common stock is most basic form of security. So the basic form of security or stock market security is known as common stock. So it offers voting rights and also dividends to the holder of that particular common stock. So we have discussed what is voting rights and what is dividend. The second one is preferred stock. So definitely the meaning itself says you have some preference over the common stockholders. So it offers fixed dividends irrespective of the company's earning, whether they earn profits or losses, you are going to receive the fixed dividend. Then priority over common stock in asset claims. Definitely you have some superior rights or upper right or first right over the common stock in receiving your claim at the liquidation of the company or any asset claims. Then limited voting rights. You may not have the same voting rights as common stockholders have. You might have some limited voting rights, or you may not have voting rights also. Then third one, convertible securities. So convertible means definitely it can be converted into, okay, it can be in the form of bonds or preferred shares. So you can convert these securities into either bonds or preferred shares. So can be converted into common stock. Then stock options and warrants. So definitely it is an option or warranty. What is that? So it is a right to buy shares at a set price in the future. So company is going to offer you the shares at a set price, okay, in the coming future. Then let's discuss another important type of security, that is debt security. So what is debt securities? So debt securities are financial instruments that represent a loan made by an investor to a borrower. So that means as an investor, you are investing in another company, but you become a lender. Okay. And the company which takes the money from you becomes the borrower. So typically a corporation or a government. So they are a cornerstone of the fixed income market and offer predictable returns. So usually what happens is in the debt market, government and other companies usually raise the debts from the public in the different forms. So we are going to discuss the different types of debt securities in the next slide. So before that, let's discuss what are the various features of debt securities. First one is principal amount. So as you know, there are two components of debt. One is principal amount and another one is interest. So principal amount is the amount borrowed by the issuer. Then interest rate. So these interest rate are usually known in the debt securities as coupon rate. So fixed or variable payments made to the investors. So fixed in the sense fixed percentage. Variable in the sense it may vary according to the company's terms and conditions and year after year. Then maturity date. So the debt securities have fixed maturity date since loan has to be repaid within the certain period. The same way debt securities also had to be repaid, okay, to the original investor or the lender who has given the money to the company. Then credit risk. So definitely the debt security holders have to bear the credit risk. So it depends on the issuer's financial health. So if the financial health is good, definitely you are going to receive your money back without any risk. If the financial health is bad, then definitely there is a risk. So what are the various types of debt securities? So first one is government bonds. So government bonds are issued by governments. It may be a state government, it may be a central government, or either it can be central government or state governments. So government definitely will repay your money back within the stipulated time, and definitely therefore it is known as, it is a low risk bonds. Then there is corporate bonds. So corporate bond means company bonds, so issued by the companies, and definitely it will give you more return, but at the same time there is more risk, and we have discussed what is that credit risk. So it depends on the financial health of the company. Then third one is municipal bonds. So these bonds are issued by the local governments. See, government bonds are different. It is issued by central and state, but municipal bonds are issued by the local governments, municipal corporations, city corporations, etc. So they are often exempt from tax. So that means whatever the interest that you earn from these bonds, it is tax free. You need not pay any tax on such interest income. Then fourth one is certificate of deposits. So in the short form, it is used as CDs. So certificate of deposits are the deposits which are done by the banks, after which has certain time period, and also with the fixed interest rate. So after the certain time period, these deposits have to be returned to the bank and with the interest. Then fifth one, last one is zero coupon bonds. So zero coupon bonds are the bonds which are sold at a discount. That means, for example, if the bond's value is 1 lakh, it is sold at 90,000 to the investor. So investor have to pay 90,000. So at the end of the maturity, what happens? You are given the full value. You are given the 1 lakh rupees. So you buy at a discount and you will get at the maturity full value. But there is no periodic interest. So interest rate will not be there. So that is the major difference between other bonds and zero coupon bonds. So now let's discuss the last type of security, that is hybrid securities. So hybrid means it is the combination of both equity and debt. See here. So hybrid securities are financial instruments that blend the features of both equity and debt. So that means they offer the features of both the debt security as well as equity securities, that is unique mix of risk, return and the flexibility. So let's discuss the various features of hybrid securities. The first one is dual nature. So dual nature, definitely it combines the features of both bonds and stocks, the features of debts as well as features of equity. And second one is income stream. Definitely you are going to get interest, okay, as well as dividends. So both you are going to get if it is a hybrid security, because it is a combines both equity as well as debt. Then convertibility. So you have an option to convert that hybrid security into a equity at a later date. So you will get the benefit of equity shareholders. You become the owner of the company, and also you are going to receive dividends. Then the last one is the priority. So priority in the sense, here you are going to get your money back before the common stockholders could get. But what happens? Yeah, it is only after the debt securities are repaid at the time of liquidation. So now let's discuss various types of hybrid securities. Basically, there are three types of hybrid securities. The first one is, you can see here, convertible bonds. The word itself says we can convert these bonds into shares. That's the meaning of convertible bonds. So bonds can be converted into shares of the issuing company, the company which has issued these bonds. Second one is convertible preference shares. So that means we can convert these preference shares into common shares. So preferred stock with the option to convert into common shares. So common shares in the sense equity shares. Remember that equity shares are also called as common shares, common shareholders. Then third one is perpetual bonds. So perpetual means permanent. Okay. So bonds with no maturity date, often paying fixed interest. So that means it cannot be matured. Okay. It cannot be repaid, need not be repaid, but you have to pay the interest till your bond exists. So interest has to be paid at the fixed rate till the bond exists. So these are the various types of securities. So before going to finish our 17th session, let's summarize what we have discussed in this session. So we have discussed basically the three types of stock market securities. The first one is equity securities, second one is uh, debt securities, and third one is hybrid securities. So thank you for watching this video.